Okay, we're not muted.
Yes, we are.
Yes, we are. Just making sure that the volume isn't going to come in the audio. As you know.
I know. That's what I did last week. It was great. It's nice.
Are you ready, buddy?
Yep.
So dramatic.
Let's go. Let's do it.
Let's go. Let's do it.
Let's do it.
Welcome, one and all, to the JWB Presents Q4 2025 Real Estate Market Outlook. This is the show that everybody shows up for. This is the podcast that everybody downloads. This is the YouTube video everybody watches. And we've done some real hard work at taking a look at what's been going on in the market, what is happening right now, and where it's going. So we're going to just dive right into this today. No roll call, none of these other savoir-faire things that we like to do, but we'd love to hear you in the chat. I'm also going to ask that you use the Q&A function to ask any questions. We're going to save all the questions to the end, so make sure that you put it in the Q&A. I'll remind you of this a couple of times, but the last thing that I will remind you of is I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
Greg, what have you been thinking about coming into this quarterly market outlook?
Man, I tell you what, my team was asking, hey, are you excited about the show today? Are you excited about the outlook today? And I'm really excited to be here. I think there has been more preparation, more due diligence, more research, more rough draft presentations done between you, your team, our team, and whatnot. So overall, I'm just really thankful for this opportunity. We've been doing these quarterly outlooks now for, I think, 2-3 years. And so I think this is a momentous quarterly outlook. And I think it's one where we're kind of in the backdrop of a year of mixed and murky economic signals.
2025 has been a year.
Yeah. It's like, we started doing this quarterly market outlook in 2020. Right. And
quite the year.
That was quite the year. And, obviously there have been some unique things along the way, but I think this one is really, really important because we have these mixed signals that are going on in the economy. I think a lot of investors, businesses, consumers, investors, we're all a little bit confused. Normally, it's hard to understand what to do in normal times, but you kind of have some indicators that are going on in the economy, and it kind of points you to a certain direction. Well, right now, a lot of those economic indicators are more confusing in their own right. And so I think if we kind of sharpen the lens to the investor outlook here, I think investors are searching for a North Star. I think they're searching for confidence. They're searching for clarity. And so I'm excited that that's what hopefully this presentation delivers for all of you.
You know what I like about this, GC, is that I'm a super consumer of content and opinions and things, as you know. I feel like many people put data out there. Many people will talk about what's happening and things that are happening. The more confident people, the folks that feel like they have value to offer, they might give an opinion, right? Like they might give an opinion on the snapshot of what's happening. What I think is different about what we do here quarterly, what you do, what you spend a lot of time, what we have continually iterated. This is kind of like the main driver of our quarter that we continue to like really dial in on, is that you're out here putting out a point of view, not just an opinion, not just facts, but a point of view. And to me, the difference between an opinion or a thesis or like a statement and a point of view is that a point of view has perspective. A point of view has a beginning and an end, and it has a path of travel that includes the perspective. And that is, to me, what's so valuable about this.
Well, I hope they all think so too.
Well, you got at least one fan, buddy. So why don't we get started here, right? Q4 2025 Jacksonville real estate market outlook. Before we get into this, as you know, we are not financial advisors. This is not investment advice. This is informational purposes only. Do your own due diligence when you're making financial decisions. There is no guarantee of outcomes here that is being promised. Anything else that I'm missing there?
Well said.
All right, super. That being said, if you're interested in this information, you're interested in more help in executing on these strategies and on this perspective, and you agree with it, you can always call JWB at 904-677-6777. You can text them right now, 904-293-0341, or you can just go make your own appointment based on your calendar at chatwithjwb.com. And the good news is we once again have turned this into a full-on report, magazine style, and everybody that's here is going to get it. Is that true,
That's
GC?
100% right.
Everybody's getting it.
Yep.
How does that happen? Emailed?
Yeah, it's going to be emailed out to everybody who's attended the show today. So we appreciate you guys taking your time and putting your time in to learn a little bit more. So you're going to get you're going to get this delivered to you by email. Well, I would say within the next day or two.
Okay, cool. And if you're listening on the podcast, you're watching on YouTube and you haven't registered for the show, this is your opportunity to show up next time so you get it. Otherwise, if you go to jwbrealestatecapital.com/reports, then it will give you the opportunity to get it.
There you go.
That being said,
everybody's going to get it one way or another.
Everybody's going to get it. GC, what I'm hoping you help me understand, I would like to get what the hell is going on out here.
All right. Well, I can help with that. So let's just kind of take big picture, start big picture, right? We see these mixed economic signals that I was hinting at. You know, ultimately what a lot of the economy and businesses, consumers, we're looking at a few things. We're probably all a little bit more in tune with things like inflation reporting data than we probably ever have been. And so we're seeing that inflation has come down. It's actually near our target. And we're also seeing that the labor market is starting to show signs of weakness. And normally when those things happen, we start to see a decrease in the Fed funds rate and ultimately a large sizable decrease in our interest rates for our 30-year mortgages. But as we're looking at it, and we'll share some of the data here today, we really haven't seen that third part of the equation. We have seen our interest rates really largely stay about the same and still stay a lot higher than we all want them to be. And so I put the slide here just to kind of take a big picture look at what our interest rates have done. This is the Freddie Mac Mortgage Market Survey. And you can see a sharp rise right around 2022. And it's not just the rise, it's not just how high interest rates rose, it's the duration that they have remained elevated, which is really, really noteworthy. When we think about interest rates basically doubling in the span of about a year and then remaining that high, that's a combination that we have never seen in recorded history as far as what interest rates have done for our economy. It increases the borrowing cost, it increases the cost of business, it increases the hurdle for an investor in order to make a good investment. So we really are in historic times, especially when it comes to the interest rate burden.
So that's the interest rate burden. Let's go to our favorite chart here that we look at the average home price appreciation and the red line compared to home pricing. How are we doing here?
You know, we have been talking about this movement towards normalization, especially over the last couple of years, as a lot of the talking head and media out there were predicting crash after crash after crash. In fact, if you've been watching our quarterly market updates, 2 or 3 of those ago, I outlined just every time that somebody was predicting a crash, and it was because of eviction and foreclosure moratoriums, or a coming foreclosure wave, or rising inventory, or whatever it is. Every single step along the way, people have been predicting a crash. And one of the things that I want to get the loudest about and help everybody see is that, you know, if you could have predicted what Jacksonville home prices would be back in 2001, right now we are within 1% of what that prediction would have been. So when we're talking about how prices are normalizing and how we predict that that's what would happen, that's exactly what we're saying. That's exactly what we're seeing. And the reality is that this is how real estate performs. Like, nobody just wants to lean into that fact, but real estate is cyclical and it is predictable over the long run. So as we have some, you know, confusing signs out there and some chaos as far as what's going on in the world, I think hopefully we can all take a deep sigh and just say, listen, you know what? Real estate is performing normally from a big picture perspective here in Jacksonville.
You know, when I look at this chart, and I think about the talk track that we have over and over on this show, this idea of, like, I've heard you say this so many times. The beautiful thing about real estate is that you have the answers to the test before you take the test.
Yes.
And to me, this is like a perfect depiction of having the answers to the test before you take the test. Right? Like this idea that we're going to travel through this red line. We're gonna dance around it at times, and right now we're like right on it. Feels like the answer to the test, right? Like, this is the ultimate predictor of something that you can really clock and count on over a long time horizon.
And this is why we choose this asset to be the foundation of how we accomplish financial outcomes.
Yeah.
This is what I saw 20 years ago. And I said, you know what? I want to do it differently with my own retirement planning, and said, I want to build assets that I know the answers to the test, that I know what pricing is largely going to be 10 years down the line, 20 years down the line. And you know, what a great asset to build your financial future, I think.
Yeah, predictability is underrated in this world of the tweet economy and political instability and all these different kinds of things. It's nice to know that there is something that we can look at and be like, oh, that's how I.
You know what the problem with predictability and normalization and boring? It doesn't sell.
Yeah,
it doesn't sell.
Yeah.
Everybody wants the get rich quick or the crash or whatever because that gets headlines, but that's just not what real estate is. Real estate is predictable. It is consistent. It's reliable. So I'm happy to be the boring voice in the room.
I'm hearing volume is kind of low on Pablo's mic is low. Interesting. Let me just double check this real quick.
Cool. Well, I'll keep rolling a little bit.
I mean,
oh, you back?
Yeah, okay. I'm back.
Oops.
I mean, I feel like my volume's okay. I don't know. How are we doing, fam? How are we hearing it right now? You guys hear me a little bit better? Sounds fine, Pops. Okay, I think people got me.
Okay.
All right, GC. So this is the wide outlook. Let's take a look at the snapshot, right?
So now we'll jump into the snapshot here.
You want me to read this off real quick?
Yeah, go for it.
So we look at the snapshot, right? This is a moment in time before we were seeing a perspective of performance over time. We've got sales data and rent data. As rental property investors, I think it's easy to get caught up in the sales data because that's what everybody has, right. But we all crave rental data because it's so important to how this asset performs. When we look at the sales data, median single family home price in Jacksonville is $360,000. Current Jacksonville home price appreciation is -2%. We're definitely going to talk about that. Median days on market, 44 days. Jack's month of inventory, 4.7 months of inventory, MOI. Foreclosure rate, a beautiful 0.7%. And then rent data, average rent price, almost $1,500, basically $1 less than that. Single family rentals rent price appreciation is up 0.5%. Homes rented year to date by JWB is almost 1,200. Occupancy rate by JWB is 96.3%, and rent collection at 98.6%. GC, what do we want to take away from these numbers here?
Well, I think we should talk about the most noteworthy thing right off the bat. So let's talk just briefly here about home price appreciation. It's actually depreciation.
Yeah.
We have a decline in Jacksonville home prices of 2% year over year. That's very noteworthy. We're going to talk more about that. Really, the basis of the rest of our talk here is probably going to be on why that's happening. So very, very unique and rare, and we're going to jump into that. I think you got to look at the sales data from two different lenses, though, right? There's that unique and rare moment where we have home price declines, but the other key measurables from the sales data perspective, things like days on market and months of inventory, very normal for the market. If you go back to 2019, our days on market right around 40. Yeah. So things are still selling here, but for real estate professionals in Jacksonville, they feel like things are slow just because they're coming off of the environment from 2020, 2021, 2022, 2023.
It's all relative.
But when you have that perspective, very normal. Months of inventory is actually below what a normal market would be. A normal market, a balanced market, is between 6 to 7 months of inventory. So if you were just looking at that in a vacuum, that would actually be a slightly indicator of home price appreciation in the short. So very balanced when it's coming from the days on market and inventory perspective. And then from a foreclosure rate perspective, guys, it is so low. Foreclosure almost just not even happening at all. I'm starting to see some talking heads out there and seeing some videos of people, again, calling for a crash because of a wave of foreclosures that are happening. They just literally must not be looking at any data. They literally must not, or they just have no perspective, or they haven't been in the game long enough. Because I'm telling you, a normal market, which is a normal market, appreciates at a rate of 4.8% in Jacksonville. A normal market has 10% of all sales as being foreclosures.
10%?
10%. That's a normal market.
So more than 10 times the current rate right now.
Exactly.
In a normal market.
Yes.
Okay.
And so we're at 0.7%. nothing to be concerned about from a foreclosure perspective. So a couple different lenses on the sales side. We're going to dive more into the price declines in a second. If we look over to the rent side, a lot of strength, a lot of stability. If you look back over quarterly market updates over the last two, we have talked about how we were going to be positioned for strength in the rental market. And all these are wins when you see these KPIs. You've got rents going up on the JWB portfolio. The overall market rents for Jacksonville continue to go up. Homes rented, we're renting the most homes we ever have from a JWB perspective. Our occupancy is above 96%. Our rent collection is almost 99%. So lots of strength, stability, consistency on the rental data side.
Again, I feel like everywhere else I look, it's so hard to get this rental data, right? Like it's so murky as a rental property investor to find actual rental data. And then I always end up, when my team is looking for stories, looking for things for the show, we always end up overcorrecting to the sales data. And it's just like, I feel remiss to not point out this idea that having this rental data, right? Like this is the full picture for our asset class within real estate. Most market updates are just about price. The fact that you guys have these 6,000 data points and you're like so deep into this market, I think it's a really good overall picture. And outside of one data point, everything looks pretty good.
Yeah.
So I would say everybody's thinking this one thing. What's up with this data point? Why have Jacksonville home prices decline?
Yeah, that's why we're here. We're going to talk about, what my intention was for this market update, maybe even more than any other time in the past, is like, hey guys, we've got something that's really unique and rare that's happening with this price decline. This is actually the first time and the only time in the last 40 years outside of the Great Recession where we've had a price decline year over year in Jacksonville. So a very rare and historic moment. So my thought coming into this market update is, guys, let's go very deep into what is driving that. Why are we having this historic moment where prices are declining, so that you guys fully understand it and can make wonderful decisions based on it. And then towards the end of our time here today, I'll give you some thoughts and some advice on what this means for you guys. So it is very rare that home prices have gone down. Again, 9 out of 10 years since 1982, home prices have gone up in Jacksonville. As I mentioned, there's only 5 years where home prices actually declined in Jacksonville over that time period. And all 5 of those years happened to be the Great Recession years. So 2007, 8, 9, 10, 11. Outside of that, we have never had home prices go down since 1982. And that's really where the good tracking comes into play as far as home prices. So a very, very rare moment. And I think it's important to have that perspective, because home prices just don't go down randomly. There has to be a formula for things to happen that would lead to a very different result when it comes to pricing than what the norm is. And for us here in Jacksonville, it's a combination of 3 years and 2 main factors that have come together to finally cause these price declines here in Jacksonville. The 2 main factors are your higher interest rates and your increasing inventory levels. When I say that, I would think most of the people in the audience who have been tuning in, especially for our quarterly market updates and for the show regularly, you're probably not surprised that those are the reasons. I'm not surprised that those are the reasons. However, what may be interesting and surprising to you is the historical significance of how high these interest rates have gone, how fast they rose. And it's not just interest rates, right? How high and fast interest rates and inventory rose, and then how long they've persisted that way. The overall pressure of those 2 primary factors, how fast, how high they went, and then how long it's remained there, is what has been necessary to see a temporary price decline.
Got it. I switched my mic out. I hope the community can tell me how my volume is over here on this mic. That being said, GC, like the words historic continue to come through, right? Like the ideas of it's not just we've seen instances of this in the past, but just not the same, right? Like there's been like sharp rises, but how sharp and how long it remained is kind of the big deal. So let's look at the data of what that actually looks like.
Yeah, because interest rates going up or inventory going up happen a lot over the last 40 years. Yeah. But it took something way outside the norm to eventually get prices to do something which doesn't typically happen.
Yeah.
So I did a deep dive on just how historic these rises are, and I think that's really good for the perspective for all of us to have. It's just not normal, but now that we have it, we can learn a lot about how did it happen. From an interest rate perspective, the average interest rate, again, more than doubled from 2001 to 2023. So on the slide here, that's what you're seeing. Your average interest rate in 2021 was 3%. Mortgage interest rate, 3% for 2021. Crazy, right?
Seems like a long, long time
Seems like
ago.
a long time ago.
When the deal was the debt.
The deal was the debt,
Yeah.
right? By 2023, the average mortgage interest rate was almost 7%. You know, when that happens to an economy and when that happens to investors, I mean, it changes everything. Way of life has changed for businesses, consumers, investors when you more than double interest rates.
Mhm.
And of course, they've remained elevated since. So the average mortgage interest rate from 2023 to 2025, basically the same.
Yeah.
Right?
Yeah.
What's interesting is the last time I went back and looked at the data, the last time, it's only happened only one other time that interest rates have risen this fast
Mhm.
and at this magnitude,
Mhm.
and that was about 40 years ago.
Yep.
But when that happened 40 years ago, if you fast forward to 10 months into the future, interest rates had come down to a more manageable level. Today's interest rate environment has lasted 4 times as long and still counting.
Yeah.
Right? That effect is what is necessary to be one of the two main drivers as to why we have the price decline we have right now.
Got it. So it's the more than doubling and then sticking around, right? Like the outlier is the sticking around piece where 40 years ago, it, kind of like came back to normal in 10 months. So we've been trying to have outlooks on this thing. We've been creating our data post perspective. Now we're beyond this kind of like time horizon of like how quickly they went back. So we are looking at a different picture today.
Absolutely.
Yeah,
If they had gone down 10 months after they went up again, we would be having a very different conversation in 2025 as far as what home prices are doing in Jacksonville.
Got it. So let's talk about the other big factor.
So similar kind of historic movements on the inventory side. Mm-hmm. Inventory levels almost doubled from 2022 to 2024. But again, home prices continued to go up 2022, 2023, 2024. And then, of course, home prices have declined in 2025. But you're looking at historically high inventory level rises. Interesting, I went back to all the data that JWB has, and we're the only people that I am aware of in the Jacksonville market who's actually tracked months of inventory on a monthly basis. And we have data going all the way back to 2006. We have never seen a time where inventory levels have doubled in the span of 2 years. So now I don't have data back before the big run up to the crash of 2006. I don't know where anybody would get that data. But all I can tell you is that we haven't seen inventory levels rise this much, this fast, and then remain elevated for this long in at least 20 years here in Jacksonville. So you've got these historic rises on interest rates and historic rises on inventory that have lasted for 3+ years. And that's really why we are where we are with pricing.
When we're talking about inventory, are we talking about total homes for sale? Are we talking about homes being built? Are we talking about homes that exist in the marketplace?
Great question. We're talking about homes for sale.
Okay.
So this is straight from the multiple listing service in Northeast Florida, which tracks all the available homes for sale in the Jacksonville market.
Got it. So we are seeing more homes for sale, even though, and it's been a historic run up, even though right now, as we sit, the months of inventory and the days on market are completely normal. The market has absorbed a doubling of homes for sale without prices going down up until right now.
That's really noteworthy, right? These same effects were here of increased interest rates and increased inventory in 2022 and 2023 and 2024. And home price appreciation slowed, but it's still, prices were growing. It's that story of resilience really is really the story that should be told as far as pricing, but eventually pressure is going to mount, right? It's going to affect demand and supply so much that you're going to see a temporary price decline.
I mean, when I'm thinking about this, I'm just thinking it's like 2022, you got a haymaker on inventory. 2023, you got a haymaker on interest rate rises and a haymaker on inventory. 2024, another haymaker. I'm still standing. Market's still doing okay. 2025, 2 more haymakers, and I'm a little wobbly.
Yeah.
right?
Yeah.
Makes sense.
Yeah. You probably, I don't know where the metaphor is going to go here, but it's like getting Tyson type haymakers in its
Yeah.
prime,
Yeah.
right? And I don't know which boxer kind of withstood that.
I don't think anybody did.
And maybe, maybe went down, or got a little wobbly, but that whatever kind of boxer could withstand Tyson in his prime is probably a good comp for what's happening with the Jacksonville real
Yeah,
estate market.
yeah. Okay, that's interesting. I think of Homer Simpson in that episode where like they show that he has too much padding on his brain. All right, so that being said, so those are two really, really big hits that have hit the market, like this overall of taking hits in the market over time. Withstood. It's, like it's almost like a cruise ship that is going down a current, and it's almost like the engine goes out, right? And then the current kind of slows, like it's still in this current, but somebody starts actually actively rowing against it. It still has so much momentum that it takes a long time before it actually can reverse, or, like can be like brought back a little bit. Like it's got people pulling back on it. I don't
You
know.
kind of lost me there. I'm just thinking about somebody trying to row against a cruise ship. Is that what we're trying to talk
Yeah, I
about
don't know.
here?
Yeah, maybe that's what it is. But I guess the point I'm trying to make is, significant market forces that would cripple somebody.
Yeah.
Jacksonville market has hung in there. This is the first blip that seems like, man, it's really actually affecting it in a real way.
Yeah. I'm talking about a 2% price decline.
2% price decline to normalization. So,
Yeah.
I know that there's another thing in there that you wanted to share with people, right?
So yeah, I thought this would be kind of a cool learning moment for us. This is something that's on our radar. It's certainly not a primary driver of why we're sitting here with a 2% price decline, but it's something that I think is a good learning opportunity. And then also that's something that could be something that's a little bit more on our radar, depending on what happens with interest rates and all of that good stuff as far as pricing. So new construction homes are a smaller percentage of total home sales. And this is the first time that this has happened since 2017. And so what I mean here is if you take a total pie of homes that are sold, you either have brand new homes or you have homes that are existing inventory.
Mm-hmm.
And for the first time since 2017, the market share of existing inventory is actually rising, or saying it another way, the market share of new construction homes is actually falling slightly. And so if we look at the slide here, you'll kind of see what I'm saying. It's been a run up since 2019 to 2022, 3 and 4, and to 2025. You see the market share of new construction homes gained a lot, right? A lot of market share. And that's important to understand because the way that decisions are made when new construction homes are sold is very different than the way that decisions are made when existing inventory is sold.
Yeah, I mean, when I hear, to me, it's confusing to say new construction home versus existing construction. What I'm really hearing is homes sold from a family to another family versus homes sold from a professional builder, professional seller of homes to a family.
Yeah, for the most part, yeah.
Right.
That's pretty accurate.
So I think it's kind of like the and if I'm gonna go a step deeper into this comparison, I would say it's like pro versus amateur. And when I think of like the difference between or somebody that does it all the time and has a much longer outlook on it versus somebody that does it one time every maybe 10, 15 years and has a very different feeling, very different motivations. And I feel like at the bottom line of it is existing homes are sold much more on emotion versus builder homes are sold much more based on a business decision, longer term outlook, tactical decision. How am I doing there?
I think you're doing pretty good. I mean, I think we're making some generalizations, but I think it plays for kind of the point that we're trying to share with everybody here, which is there's a different set of priorities that lead to different types of decisions when you're talking about a professional home builder versus an individual who is selling their home. And it really starts to show when there's a slow sales environment, which is what we have right now. On the builder side, the priorities are different because they're not just the builders are here to make a profit. They're not just here to protect the profit on that one house.
Yeah.
Builders are there to protect the profit on the next 100 houses that they're selling very close to that one house. And so when you compare that to an individual seller, if something's been on the market for 90 days and the seller has already moved and they've got a house and somebody comes along and is 10 grand off of their asking price, the individual is going to be much more likely to take a price discount to be able to get the home sold. So the individual doesn't care about the ripple effects of the next 100 homes sold in that neighborhood,
True.
right? They're trying to solve their problem. So home builders look at price discounts as an absolute last resort. And the way that they incentivize activity, even in a slow sales environment, is they buy down interest rates and offer large concessions and will fix pretty much anything in the home as long as that purchase price still stays at the market rate. Because again, they're trying to protect not just today's profitability, they're trying to protect next month and next year's profitability as well. So again, interesting to look at, not something that is moving the needle right now, but in all of my research, as I'm looking at all of these things, I'm like, you know what, this is something to pay attention to. I pulled the percentage of new construction sales that are happening over this year, January through June. You're starting to see it tick down a little bit. Now, to go from 28.6% to 28.3%, is that moving the needle? No. Right? No, but this is an early indication, something to watch for, because it does contribute to the way that pricing decisions are made. And if we would start to see a large percentage shift there, then it could really, have more of an impact on pricing.
Got it. So if I'm gonna summarize what we've been talking about right now, the market overall seems relatively healthy, minus one giant data point, which is the idea that prices have gone down 2%. The reason for these prices having gone down 2% have two major reasons. One is increased interest rates that have stayed longer than ever, and increased inventory that has stayed longer than usual as well. And there's another kind of like flag out there that may or may not be a data point that we're going to continue to watch and continue the wind speed and direction of it all. That is this trend for builders, which has, up until now, any other weaker market or any other weaker asset class probably would have shown signs of a slowdown, signs of like a depreciation going down. In real estate in Jacksonville right now, we've kind of withstood these like giant headwinds for the last like 3 years. And now, these headwinds have finally actually not just slowed us down, but sent us into reverse slightly. And that is down into the average trend line going forward.
Yeah, I like everything you said there. There's a couple adjectives that you threw out there that I think are a little bit more momentous than they need to be, right? We talked about what's a healthy market. I would look at a healthy market is how is it performing compared to the long-term trend line. So the fact that we're within 1% of the long-term trend line to me is a healthy market. So I don't think we have to worry about the health of the market, but everything else that you're saying as far as what is leading to the temporary price decline is 100% accurate. And ultimately, the long-term trend line is what makes it such a good decision to buy in a growth market like Jacksonville, right? The long-term trend line is the thesis for how you're going to have better returns by investing in Jacksonville than other assets and than other markets that you're investing in. So there's two lenses to look at. Long-term, really healthy. We're within 1%. Short run, an anomaly. Right? It's an anomaly. It takes a lot for this anomaly to play out. We're seeing it play out in real time. And it's good to understand why that's happening. But it is ultimately, if you're somebody who is buying and holding this asset class, it's nice to understand this, but you got to buy into that long-term, the long-term healthy trend line, which is exactly what we're on.
So when we think of market anomalies and we think of long-term success, I think the first thing that comes to mind for folks is, 2008 was an anomaly. And, we sit here 30 years later, we've recovered. Is it going to be the same? Are we just kind of like on the same ride for 2008 right now?
Yeah. And I think that is a good question from an average investor perspective. I'm going to take a few liberties here because we have talked about this multiple times with our community here. And for those who have joined in before, this is not the first time we've heard this question. What happened in 2008 was completely different than 2005. And there's a lot of data points that we can show. And I've put some of the stats here, so we'll put some of those up here. But maybe this is good for you if you happen to be in a conversation with somebody who says the sky's falling because home prices are down 2%, and this is a harbinger for what's going to happen and whatnot. Maybe some of these data points kind of help you here. But ultimately, guys, in 2025, we have $35 trillion of equity in our homes here. $35 trillion of equity. When you have $35 trillion of equity, it comes out to about 300 grand of equity per homeowner in the country. Really hard for there to be a crash, right? You have other things that are pointing in the direction of stability overall, and you just didn't have stability when it was 2008. You had a problem that was caused by lending practices in 2008, and you didn't have a lot of room as far as equity. And it was all equity that people, largely just signed a piece of paper for. They didn't actually put any money down for it. So it's completely different than 2008. 2025, this is there's no way we're gonna have to crash.
I mean, when we were preparing for this GC, I told you I like the idea of like single stat arguments or single stat businesses, right? Like this type of idea. And to me, this difference of the difference between walking away from 100K in equity versus 300K in equity is a massive, massive difference. A, and B, to me, the underlying real difference is that 100 grand in equity in 2008 was coming from folks getting all interest loans, no money down. It was this like phantom equity that people were just like, well, I have a house and I'm going to flip it. And all of a sudden I got this money and it's all on paper. I've never actually felt it. Whereas the loans and the equity that is in these homes, these 300K in equity, you can basically guarantee that there's a significant portion of there that is money that somebody saved up, that made sacrifices and didn't spend it on certain things that they wanted in order to put that money away, in order to put it into a piece of real estate. And that equity is much harder to walk away from than whatever this thing appreciated since 2021 kind of thing. Just like in the Great Recession, people were just kind of like, well, I'm just walking away from something that was never really mine.
Yeah, they had never seen the home. They never even, put the money down themselves. In order for there to be a crash, guys, there has to be a lot of foreclosures because you have to have a massive amount of properties that are selling at extreme discounts.
Yeah.
And then it's kind of like it's a flywheel that you don't want to be a part of, really, is what would have to happen. And that's why when you have so much equity and you have tighter lending standards, it's just not going to happen. I mean, put it in perspective. The most that interest rates have risen in 40 years, the fastest, the biggest magnitude, and the longer they've persisted.
Yeah.
Same thing with inventory. And we're looking at a 2% price decline year over year.
Yeah.
Right.
Yeah. So if I'm at a cocktail party and people are like, prices have gone down, you can be like, yep.
Yeah.
And then people can say, the market's going to crash. You can be like, not so fast, my friend. Right. Like the big difference here is people had 100K in equity that was never money that was ever in their own pocket in 2008. In 2025, they have 300K in equity, and a lot of that came from their own pocket first. People are not going to walk away from that. And on top of that, you can talk about the rest of this crap, right? like percentage of adjustable mortgage rate applications, 33%. People were seeing like a cliff of pricing going up versus 8 to 10%. People are just not that many people are going to see this like increase in price. Foreclosure rate, 20 to 40% versus 0.7%. That's kind of a no-brainer of things that won't lead to a crash. U.S. unemployment rate in 2008 was around 10%. We're still at 4.3% right now. So people are making money. They're being paid. Like we're pretty well employed. And the mortgage interest rates is also a big, big difference, right? But like the main one is very interesting, very easy to like conceptualize. I'm not going to walk away from 300K, and I'm especially not going to walk away from 300K when a lot of that was my money that I put in there to begin with.
Yep.
Okay. All right. So that was a good point to make, GC. So, what does this mean for rental property investors? Like so far?
This is a time to stay the course. This is a time to just have a conversation with yourself. And, if you're a JWB client, have a conversation with us and just remember why you chose this asset class. Yeah. Remember that, this is an asset class that is consistent, that is reliable, that does create these financial outcomes, and you just have to follow the plan. So that's my message for all of our clients and for those who are investing in rental properties in the Jacksonville market, especially. Stay the course. This is a time for a steady hand rather than a knee-jerk reaction. Be prepared. We know that the negative headlines are already here, and they're going to come more and more as more of, as price declines are reported more and more. Got to avoid the noise. You got to cut through the noise. Stick to that passive income plan that is based on your goals to deliver that financial outcome. If your plan dictates that you should be buying a property this year, you should be buying a property this year. If your plan dictates that you've bought enough properties and you should be holding properties until that time when you reach that goal, you should be holding on to those assets. Recognize that listening to headlines and selling at a time of temporary price declines does not maximize your return on investment. This is a time, I think, to build up cash reserves because there's a whole lot of confusing signals in the economy. Yep. And so I think that is a really strong thing to do. And just, be a part of the conversation with the expert that is helping you manage your money in rental properties, especially, right? Because, lower interest rates likely are coming at some point. And that creates not just a great buying opportunity, that creates a great opportunity on the refinancing side. Yep. And, that means that you just increase your cash flows, increase your return on investment. So there's a lot that we can do to refine a portfolio for what's coming down the pike as well. But I think it's just a time to stay the course.
I'm going to ask you two very specific pointed questions. That is what really people here came here to see. What do you think Jacksonville market prices are going to do in the future? Like when are they going to come back? Like what do we need to know about that?
Well, so it's really simple. The answer to that question is home prices are going to come up again when interest rates go down to a meaningful level. It's just very simple. We understand that the historic nature of the rise and the magnitude and how quickly they went up and how long they've persisted. And we understand that there is a lot of room for them to come down. And we understand that when low interest rates happen, that is the biggest lever you can pull for the housing market because it increases affordability. We should be able to get ourselves to a place where we understand it's a pretty simple equation. Now, what does that mean for interest rates to actually come down, and what is a meaningful level? We still have to figure that out together. Yep. We don't know when they're going to come down. We don't know how much they're going to come down, but they will eventually. And so ultimately, we're going to see home prices go up again when interest rates come down.
I see people licking their chops in the chat right now. I see Steven, I see Marva, I see Andrew all predicting that the Fed is about to drop interest rates. For us, the languaging we've put around this is we lovingly call it the coil effect.
That's
it
right.
Gives me purpose as a sound effects guy. But this idea of when
you want to do it.
Yeah, I want to do. All right. So when interest rates are low, it pulls forward future demand, right? Like we saw this all from 2020, 2022. Once interest rates are high, it slows it down and kind of like suppresses demand. But when interest rates drop again, right? Like the coil goes and home price appreciation takes into effect. There you go, Billy Green. I gave you the boing. We've talked about it a lot. So I think this idea of, we are seeing interest rates coming close to dropping again. All the signals are there from the Fed is happening. I feel like we see the momentum just like in the chat. But what you're saying is, yeah, they're going to do it, but it's all about like, how quickly do they do it? Do they do it multiple times? Or are they just dropping once and then it's going to stay there? That's going to be like more of a measured kind of like rebound.
Yes, and I'm taking a more measured tone, even though I know the Fed's about to meet and everybody's predicting a Fed rate decrease. Ultimately what affects us in this lens here of rental property investing is our average 30-year mortgage rates. And what the Fed doesn't necessarily mean that our average 30-year mortgage rates is going to come down. Like, for example, the last time the Fed dropped it 50 basis points, interest rates actually went up for a 30-year mortgage. And so I think that's why we need to pay more attention to it. I'm going to be measured in my approach because I'm thinking about average 30-year mortgage interest rates. Those are indirectly affected by what the Fed does. Now, here's the positive. The Fed didn't do anything to drop rates over the last 3 weeks. And the average 30-year mortgage rate has gone down significantly. It's actually gone down about 0.5%, 0.25% to 0.5%. So there are things that can happen to affect our 30-year mortgage interest rates that are not exactly dependent on when the Fed says, yes, I'm dropping it. It's more about what the Fed is signaling. So a few weeks ago, the Fed started signaling and the reports started coming out that it was likely to happen. And that's when rates actually went down. So big picture, at some point, we think rates are going to come down because the Fed has told us that they want rates to come down.
Yep.
We don't know what that what that journey exactly looks like. But we know that normally home prices go up in Jacksonville. And we know that when rates come down, interest rates come down, that has a positive effect on home prices. So we can naturally draw the conclusion that the Fed wants them to come down. They're going to come down at some time. And when that happens, we're in line for some better than average home price appreciation, because right now we're in a period of 2% depreciation.
Got it. Now the big questions you see.
Yeah.
I'm seeing Stephen White asking people who's ready to buy right now, because he seems to be, Marva's kind of bouncing it around there. Michael Santoris is saying that things have already dropped. Drew is saying that he's bought a couple. Based on all this information, is right now a good time to buy rental properties in Jacksonville?
Yeah, it's great to already see it in the chat. You guys are such a savvy community, and together we kind of see things, I think, the same way as we've been on this 5-year journey of analyzing markets. So the answer to your question, Pablo, is yes. It is a great time to buy right now. And it comes down to the same principles that I started to buy with back in 2006, and the same principles that you all have made buying decisions on recently. It comes down to, does the asset produce positive cash flow? Well, today we're getting more positive cash flow than even we had 6 months ago or a year ago.
Because of the recent interest rate drop?
Because of interest rates dropping, and because, as prices go down a little bit, rents are still going up. So we actually have more cash flow today, which is great. So do we get positive cash flow? Yeah, actually more now. Do we have reason for optimism as far as what the market is doing? We've talked a lot about where the Jacksonville market is and how optimistic we feel like we are. And it's not just about all of the wonderful downtown activity. It's about Jacksonville as being a metro that is designed for growth, even if we didn't have that large, amazing influence on the growth of the market. So we've never been more excited about the growth of the Jacksonville market. And then the third component is the team to get you to your finish line, to get you to your financial outcome. We're going to celebrate our 20-year anniversary on January 6th of 2026. That's about 20 years that we've been in the game. Through those years, we've started in a place where we were trying to figure it out 20 years ago, largely on the back of my portfolio, and to think about where we are today with the talent that we have, the systems, the quality of individuals that we have on our team, the mission that we're on. There's not a better time or a better team to support that. So when you have all three, and those are strong, positive yeses, and sometimes it's better today than it even was a little bit ago, the answer is yes. The answer is it's a good time.
Yes. What I hear from you in this answer is essentially just like first principles thinking, right? Like, what are we looking at? We're looking at an investment vehicle inside of an asset class that is designed to support us in retirement, right? And the qualities of our vehicle are, when you're looking at an investment vehicle, you think of, do I like how it feels in the short run? Will it work in the long run? And do I have what it takes to make it to the long run, right? Do I like how it looks in the short run? Today has, like the conditions for making it palatable in the short run for rental property investment is positive cash flow. Right now, cash flow is up, right? Prices are slightly down, interest rates are slightly down, rent is up, cash flow is up. Does it look good in the long run? I don't think anybody here watches this show without knowing that Jacksonville is poised to be the next great American downtown, to be this city that has all these headwinds, a balanced economy, long-term growth. All the trends point to long-term growth in Jacksonville, which is what makes it really attractive for everybody. And then, so that means, yes, good long-term with really nice upside potential and a really high floor. And then what does it take to make it to the long run, to get to that finish line? It's an operator. And you're looking at JWB as an operator at 19 years in. You're not getting worse at your job. You're only attracting better and better talent, right? Like, you guys have more and more capabilities. You have a better name today, and like all this data, everything that you're doing. I think it makes a lot of sense to say that it is a good time to buy, regardless of like how different the data came out today.
Yeah, I mean, I'll say, listen, if you are a buy and hold investor, this is a good time to buy. If you are, and I like this for our community and for the industry too, because I think a lot of times people have wanted too many things from rental properties. Yep. The way you win is you buy and you hold. Yep. If you are an investor or you're a flipper, and you have a very short run outlook, and you might think about being in the game for 3 years. You're not really sure. This is not the time to buy rental property.
Yeah.
So I think what it's doing is it's kind of creating more of a line in the sand, I would say, as far as what makes a great investment for a specific type of investor than kind of being all things to all people. So, you know, if you are somebody that wants to build that outcome on the back of something that, and you're willing to hold on to it for 10 or 20 years, this is a wonderful investment in the right time.
Speaking of people making that outcome, this is just the scoreboard that we continue to show of our community right now. Our community has had profits of 317 million plus. We have 777 in the 100K plus in profits, 180 in the 500K plus in profits, 41 that have made over $1 million, and 4 in the 2 million plus. There's 5 and 6 that are close. We should have a big party for that one.
That's
and
right.
Just to remind you, if you want to join that club or you want to continue to add to your profits, call JWB at 904-677-6777. Text only if you just want to text and get somebody to get back to you, 904-293-0341. Chat with JWB.com if you want to pick a time. And right now, GC, let's get into the questions.
Let's do it.
Right. By the way, we have 90 plus people here. So I want to just invite you to continue to join us on Tuesdays. This is me and Greg's baby. This is our community. We love hanging out with you. We continue to do this week over week now for 5 years and counting. Let's get into the questions. You see, we got 11 of them.
Okay.
Lee Bishop says, tomorrow's Fed announcement should be interesting.
Put those over there.
I
buddy,
will.
so
I
can
will.
do
I
a
will.
little
I
bit of
will.
reading as well.
So Lee just says, tomorrow's Fed announcement should be interesting.
Should be interesting. All eyes are on that one. I'd be really, really shocked if there's not a decrease to the Fed funds rate.
Yeah, totally. Miguel Angel, my friend, good to see you, man. Miguel Angel Sanudo says, how is rent price appreciation versus costs, property taxes, insurance costs, et cetera?
Yeah, so I mean, year over year, rents have gone up about 0.5%. It's property taxes on a percentage basis have gone up more than that. Insurance costs are interesting. We just had the insurance show last 2 weeks ago, 3 weeks ago, and we talked about potential decreases on the insurance side. I don't want to get people too fired up about that because, you know, I want to underpromise and overdeliver, but I think it's fair to say that that by and large insurance costs are not going up at the same rate they were before. And fun fact, Florida actually has the lowest percentage of insurance rate increases in the entire country last year to this year. So I think things are certainly stabilizing. We have an opportunity potentially for decreased insurance costs.
I found it really interesting that Whitney said that Florida went from being like the warning case for the rest of the country to now the rest of the country is trying to learn from us because of how stable our insurance market has become. Christine Crockett, I think you answered this question, but does the dropping appreciation rate indicate a good time to purchase despite current interest rates?
Yes, as long as you're a buy and hold investor, this is a wonderful time to continue to add.
Leslie Brooks asks, why has inventory increased so much?
Yeah, just a combination of things. You know, ultimately, we talked a lot about this effect called the lock-in effect for a while. And that's when, you know, in 2021, everybody who got a mortgage was locked in at like a 3% interest rate. And so if you're somebody who has a 3% interest rate on your mortgage, it's going to take a whole lot more for you to want to give that up, right? Because as home prices went up so much, in essence, if you sold that house and lost that mortgage, you'd end up buying a new house and you'd get less house for the money because your interest rate was largely 6.5 or 7%. So that lock-in effect basically restricted inventory on the market for a while there. At the same time, you had builders coming in and builders understand that we have an undersupply of homes in the market. So they continue to add inventory. And now we're 3 years removed from those longer interest rates. That lock-in effect is less impactful. It's less meaningful, meaning that less people have those 3% rates. And so more people are willing to basically put their house on the market than was the case 2 years ago or 3 years ago. So combination of the lack of the lock-in effect or the amount of time since the lock-in effect originally went in increases supply. And then the amount of homes that are being built has certainly increased the supply as well.
Good answer.
But I do want to point out that we're in a healthy place for supply. We're actually undersupplied still. So when we look at how much supply has gone up, what else has gone up is home sales have gone up, and that's reflected in that month of inventory metric there. So I do want to make sure that people leave with the idea that we are not oversupplied, even though inventory has increased so much. It's just the fact that we were way undersupplied.
Correct.
Back in the day.
Yeah. We had that moment on the report today when we said it's doubled, and we're still under the average months of inventory
Exactly.
inside of Jacksonville, right? Anonymous Attendee has a question here. I remember when I bought my house at 9% interest rates for a long time, and real estate still went up dramatically in California. Can you compare?
Sure. You know, a lot of information that I would still need to understand in order to do a really good analysis there. However, what I can tell you is that interest rate is a factor of the decision. Ultimately, home price affordability is a big driver of demand. And so when you have homes that are affordable and you're in a market that is growing and people are moving there, you can have home prices still go up, even though you have what we would perceive to be high interest rates. If you go back and look at the 80s, we had like 18% interest rates, 12% interest rates. People were still buying homes and homes still went up in value. And the reason was because home prices were so low at that point that they were still affordable. Now it's a little bit of the opposite, right? Now home prices are really high. They've risen so much. And now our, interest rates, again, feel really high right now, even though by historical standards, they're actually very normal. So hopefully that helped you there.
There you go. Stephen White, who's been super chat, like great in the chat right now. You can tell Stephen is a sophisticated investor, probably an active investor, or maybe has like a mix of things. He's asking, do you feel Jack's market has hit the bottom on transaction volume and will slowly start increasing in 2026?
Hard to say if it's hit the bottom. We actually are going into the slower season from a seasonality perspective. So I would say probably haven't hit the bottom as far as transaction volume. I think, again, that's largely interest rate dependent. It could be the bottom if, rates would come down dramatically and stay low. As soon as that happens, you're going to see sales volume pick up. You're going to see home prices continue to do what they normally do, which is to appreciate.
Love it. Another question from Steven. What is your offer writing strategy right now for buy and hold investment properties? Do you expect Q3, Q4 to be the sweet spot?
What is our offer writing strategy? So I'll take it from the lens of a rental property investor, meaning like you as a rental property investor. Sure. You should be buying properties that produce positive cash flow, and between a 10 to 11% IRR or return on investment is really what you're looking for. And making sure it's completely passive to you. That is the formula that works. That formula has worked for 20 years now for our clients. And so do I expect that this is the sweet spot? It's interesting. What do you mean by sweet spot? On the show, it's funny. Paulo and I were talking about this when we were prepping yesterday. It's like, at the end of the day, I love this asset class because you don't have to define a sweet spot for you to win. True. Right? You simply buy the asset, you hold the asset, and because it's so consistent and predictable and reliable, that it will get you to your financial outcome. What you need is a team to make it enjoyable for that 10-year mark or that 15-year mark required to get you to your outcome. So I don't think that there's really ever a sweet spot to be doing this. I think you need to get these assets into your portfolio as early as you can, get the right number of assets there. If you're not sure how many you need, talk to my team. We can define that for you. And then you just simply hold. And it's just simple and boring and predictable. And that's me. So there you go.
I love it. And it reminds me of one of our first shows we ever had where we asked everybody each founder's superpower. And yours was the turtle.
That's right.
Yeah,
I'm the turtle.
The turtle wins the race. Anonymous Attendee, great question here. Having their own acquisitions team and personal rental income portfolio here in Jacksonville, withstanding a couple of market cycles and being a leading expert in this market, it stands to reason that JWB has a stance on their business strategy when it comes to this time in real estate or time in the market. How are you posturing yourselves at such a time as this? How are you using this data to fuel your business decisions?
I feel like the whole presentation has kind of answered that question. I don't know.
Well, I guess another way to ask this is based on this data. Are you guys changing any kind of strategy? Like you guys meet
buying a lot more.
You guys are buying. That's the answer, G.
Yeah, we're buying a lot more.
Yeah.
I mean, we think this is an opportunity to buy.
Okay.
Just like I'm telling you guys to do. And you guys will get to see, we're going into business planning in about a month now. And as we do always, one of the first times for us to share the business plan with the communities here on the show.
Yep.
So you guys will see it. It's already being talked about. We're going to be ramping up buying because of the same things that I'm sharing with you guys.
What does buying a lot more look like? Are you guys buying more plots of land? Are you guys buying more homes? Are you guys buying more downtown lots? Like
The first two.
first
You know,
two.
our downtown activity, we are done acquiring for downtown.
Yeah.
And that's actually a part of the relationship with Gateway. So JWB is not buying anymore for Gateway. And we are really excited about everything that Gateway is delivering on the downtown.
Yeah. You got yourself an operator.
We got ourselves an operator.
Yeah.
So, but we're buying the same thing we've been buying for 20 years. You know, land, right? Lots of lots that can turn into brand new construction homes that can be turnkey rental properties for you, and existing homes that can be renovated to a high standard that will turn into turnkey rental properties for you. And a portion of what we buy will also turn into what we call retail homes. So we do sell a portion of what we build to people who want to move into the home. And really for our residents too, who want to become homeowners, they can become homeowners and move into the home and purchase the home. So the model it's going to be the same. You know, I think boring is an appropriate word for me, because our model is boring, right? We do the same thing largely over and over and over again. We pull some levers just slightly, and that's what we're going to be doing. One of the levers we're going to pull is how much are we buying next year?
There you go.
We're going to be buying more.
That was the answer. That's the answer the anonymous wanted. Thank you, Greg. When I think of you, I think two things. I think boring and super athletic. All right. So we got a question from Michael Santorius, patron Santorius. Greg, I may have missed it, but is JWB seeing longer rental days on market over the last few months? I just put up this snapshot.
Longer days on market over the last few months. I mean, our days on market dropped dramatically, especially after the first quarter into the second quarter. There's a little bit of seasonality to it. So you generally do see some longer days on market as you're going into the fall and into the winter months. We dropped our days on market so significantly coming off of Q1, where we rented more than we ever have. So to answer your question directly, yeah, it's probably a little bit longer on the days on market on the rental front. But I'm not concerned about that at all. It's really about us being able to deliver the rent rates that we need, the occupancy that we need. So over 96% occupancy is a really strong metric. So yeah, I think it's a little bit higher, but right in the zone of performance that we're looking for.
Got it. HCTN has a question. HC just bought a property recently and seeing prices going downwards, is wondering if Duval County will assess taxes. Will they automatically consider a market downturn and reassess for owners if they're contacted? Or like, will they adjust taxes down?
It's interesting. We haven't talked about property taxes potentially going down since I owned property in 2008, 9, 10, 11. I actually saw that, which is interesting. When would it happen? It would actually happen potentially next year. So they just have assessed the taxes, which is for the previous year. You know, if your home value, if they assess your home value is actually going down, then you could see property taxes come down. However, property tax assessed values are one component of it. The millage rate is the other component of it. The millage rate is voted on as far as how much you're charged based on what your assessed value is. So two components there. So long-winded answer, it could happen for you this year. The price declines that we're seeing right now would actually be reflected potentially in next year's taxes, but it's hard to make macro statements there because ultimately there is a person from the county that goes and assesses each home individually. And you never quite know what that individual is going to do. So what you may want to look into is actually challenging your property taxes. Anybody can do that. So as you get your property tax bill, if you're looking at it and you're saying, hey, this seems higher, you can actually dispute your property taxes. Hard for me to say whether that's a good use of your time right now because we don't know what that assessed value is. But if you need some help, reach out to my team. We can give you we can't do the dispute for you, but we can give you some insight and say, well, that's give
you some ammunition.
Or that's probably not an opportunity that you want to go and waste some time.
Okay, 3 more questions to go here. No more new ones. Bob Wiesner, my buddy, asks, if you look at permits for future SFR construction in Jacksonville, do you anticipate a slower or faster rate of new home completion in the next year or two? What will happen to the supply?
I think you're going to see more homes being built because more homes have been in the pipeline. More permits have been pulled for single-family rentals over the last couple of years. So I think you'll continue to see that, and that's okay because we still are undersupplied when it comes to single-family rental properties. So I think you'll continue to see higher numbers there, although we are starting to see some pullback now recently. And a lot of times those are builders making decisions right now that will affect completions of single family homes a year from now to 2 years from now. So, but if we're talking about next year, I think you're going to see a similar number of completions on the single family side. I think that's okay. And if we're going a little bit longer, the fact that builders have sort of pulled back and are not buying as much land today is an indication that the supply problem is still going to be here for many years in the future, and another good reason to have the asset where you don't have enough supply of it.
Cool. The better Gregory Stone from New Jersey has a question. Does the type of inventory make a difference in assumptions? Owner occupied versus foreclosure versus new build versus fix and flip?
Does the type of inventory make a difference in assumptions? Owner occupied versus foreclosure versus new build versus fix and flip. I'm not really sure the angle that we're coming from here, or the better Greg. So maybe help me if I'm not going down the right path. But ultimately, if it's a home that is a foreclosure, or if it's a new build, or it's a fix and flip, or whatever, from the lens of a rental property investor, there's only one definition of winning, right? It doesn't matter how it got to the place that you're investing in it. When you run the numbers, it should produce positive cash flow. It should have a 10 to 11% IRR based on market conditions, which is what they are right now. And it should be completely passive for you. And so that's the win there. I don't care how it gets there. If it was a foreclosure back in the day and then somebody fixed it and then gets it to that place for you, that's a win. If you want to be more active and you want to go and buy foreclosures yourself, first of all, good luck, because there's not a lot of them at all. Then the equation can shift. You're putting more time and energy, you're taking on more risk, and you would require a higher return on investment to do that, and also a return on your time, because you're going to be taking all the time to be able to do that. So hope that helps you the better, Greg. And if it doesn't, show back up next week and I'll answer the question again for you.
The good news is that Greg has conceded the better Greg thing, so naturally. All right, Leo, Faraganan. Leo, final question here. Any news or update on Jack's new stadium? It is called the Stadium of the Future.
It is called the Stadium of the Future. No major news as far as the stadium renovation, other than it's happening right now. I went to the preseason game for the Jags, and it's hard to walk in now because things are walled off and you can't get access to certain things.
Staging areas are causing drama for the game day experience,
which is great.
Yeah,
we love this. We love this. This is a natural part of what it takes. So the money is there, the approvals are there,
the dirt is moving.
So super exciting. And for all of us who come down for the summit, which we do February, March, we're not sure the date next year, but when we do that, you guys will get to see it. It's been happening really for 3-6 months now, and so exciting times.
It's nice to be excited about a stadium when the team isn't giving you much to be excited about.
I know.
All right, GC. Good job, buddy.
Thanks, man.
Good job, buddy. Good stuff with a quarterly market outlook. Good time to buy as ever, right?
Yeah.
Fundamentals are still there. The first principles of this asset class are, do you have positive cash flow? The answer is yes. Better today than yesterday, as a matter of fact. Do you have a good long-term outlook in the market? The answer is yes. Jacksonville is going to continue to catch fire, and it's going to continue to have this renaissance of downtown and do all these things and attract corporate relocations and the best job markets and the best students through the things that are happening. And do you have an operator in place to get you there? The answer is yes, if you do business with JWB. So, this is a great time to buy. Go to chatwithjwb.com and pick out a time.